Hi, my name is Stuart Weems and welcome to the Investopoly podcast. My goal is to share easy to understand evidence-based holistic insights to help you master the game of building wealth. Okay, let's get in today's Q&A episode. I've got the first question. It's a bit of a big one. The person that wrote in didn't want me to use their name, but they didn't give me a pseudonym. So I'm just going to go with Anna for the sake of picking some name. Anyway, Anna writes, first of all, thank you for the incredible work you do for the podcast. I recently discovered you also publish on YouTube, but the podcast format works really well for me. I often listen when I'm driving, cooking, gardening. It's always a pleasure to hear your thoughts, balanced insights, and I also appreciate you keeping it to information without turning it into a sales pitch like many others. So thank you for doing that and keeping it real and genuinely helpful. So thanks so much, Anna. I've said a few times that I don't want this to turn into a sales pitch. As I said last week when I covered the Vanguard episode, so I'll always be really focused on that. And yes, we started doing a bit more over on YouTube, just in case Apple plays around with the podcast ratings and rankings and all that sort of stuff. I kind of like YouTube. People can comment and ask questions on the specific episode and get perhaps more timely responses. So if you do have any questions, you can head over to YouTube and ask any questions there, and we'll see how that goes. Okay, so Anna is giving me a whole bunch of information here, and I'm just going to give you a summary. Her question is, do I set up a self-managed super fund? That's her question, but I think I'm going to change the question. I'm going to make it a bit more broad than that because I don't think that's the real question here. It's really a strategy question, and it kind of links into an episode I recorded previously. Anyway, let me give you Anna's details. She's 43, her husband's 47. They've got 3 kids, 20, 14, and 7. So that's a big age gap there between the kids, the 20-year-olds at uni and working and so forth. Combined super is $420,000 with Colonial First State. Anna's salary is 160 plus bonus. Husband is 180 plus he does some tax-free work on the side, $20,000 to $30,000 a year. They've got 7 investment properties. Total value is $6.5 million. Around about. Total purchase price is about $4.5 million, so about $2 million of equity there. And net debt is about $2 million. Now, it sounds like a great position, and it is, of course. They've got a lot of equity in the property, but the loan repayments are about $18,000 a month. And the gross rental income is about $140,000 a year. So by my calculations, it's almost sort of $115,000 cash flow shortfall. So, very much, I'll describe that as asset rich, income poor. And Anna, in fact, talks about one of the issues is they bought a small beachfront apartment they want to use in the future. That's also negative cash flow. So it wasn't a pure investment decision. And Anna also said they considered selling one of the properties in January 25, but liked the property and thought it'd be a shame to sell it. So they were kind of keen to hang in there. And so, which is kind of understandable, of course. And it goes on to talk about they've lived frugally for years, but they're starting to get a bit sick of it, a bit sick of the rat race, sick of just working to make loan repayments and not enjoying any of the fruits of their labour. And it goes on to sort of say, thinking about setting up a self-managed super fund because they're heavily geared into property already. They don't want to buy any more property in their own names. She makes a comment that, super funds go up and down depending on what's going on with the economy, but property tends to either grow slowly or quickly, but steadily over time. And that's really just a comment around, historically, residential property in Australia has half the rate of volatility than the share market. So we all know that. I mean, we conceptually know that, but that's certainly the evidence and the numbers. And putting property inside a self-managed super fund to Anna makes sense because they can still use the leverage, but it doesn't affect their personal cash flow. And they really want to benefit from some gearing because Anna's saying, well, our super's not huge in terms of balance. Interestingly, Anna goes on to say that they've already paid for 2 rounds of advice, one from a financial planner and another for a property plan. Both were expensive, around $6,000 each. And honestly, I'm not sure we got deep value or actionable insights. Both said, do nothing, keep doing what you're doing, and you'll be fine. Okay, so what she really wants clarity on, what is the path moving forward. So it's a really good case study, I think, and a situation because a lot of property investors kind of fall into this basket, if you like. And I want to refer to a previous episode, 358, which I sort of spoke about. Well, the title is How Much Wealth is Enough? But the episode was really about two things. Firstly, if you're already on track for retirement, then why don't you just enjoy life a little bit more? So, like coming back to Anna's question, she feels like they've been living really frugally and paying loans, and they're just sort of on that rat race, if you like, and have been for, I would imagine, probably a couple of decades, and they're getting tired of it. But, the argument is, well, if you're already in a position where you're going to have more than enough wealth, relax a little bit and just sort of, I mean, none of us know how long we've got left on this planet. Hopefully we get to enjoy a really long and very healthy retirement, but it might not be the case. And so that was sort of part of the episode 358. The other thing too, in that episode, I sort of spoke about the tax effectiveness of super. And the problem with a lot of property investors is they end up having too much wealth outside super. And it's really ineffective because obviously then you're going to be paying tax well into retirement as well, where people that have fully utilized the benefit of the super system end up paying no tax. And there's a big delta, big difference between the two, of course. And Anna's situation is case in point, right? $420,000 of wealth inside super. And if you just look at the pre-tax sort of gains, we're talking about $4 million of property outside of super. So, you've got sort of 10 times more wealth outside of super in a environment where it's fully taxed and, very little wealth, a little bit more than 10% of total wealth inside an environment where there's no tax. The issue with respect to Anna's comments is that she sort of implicates that you can magically get all that money inside super. So that if we could just magically change all those properties and put them inside super, wouldn't that be great? A couple of problems with that. Firstly, we've got contribution caps. So we can only make a certain amount of contributions each year, both concessional and non-concessional. So the concessionals are $30,000 a year and the non-concessionals are $120,000 a year. Or we could bring forward 3 years. And in fact, you could straddle a financial year, make one non-concessional contribution this year and bring forward 3 years in July. So it allows you to kind of get in 4 times 120, so 480,000 in 1 year. So it is possible that between, for a husband and wife, two spouses, they can get, almost $1 million into super in one hit. But that's all. Like, you can't get much more than that. And they've got $4 million of equity in property. So it's going to be a long time before they can really get that into super. So that's the first problem, is the contribution caps. The second problem is serviceability inside and borrowing capacity inside super. Remember, the lender can only really rely on your contributions, your historic contributions. So let's say that's $30,000 each, 60 grand in total, and then the rental income. But remember, they're only going to take into account 70 or 80% of that rental income to account for expenses. So your borrowing capacity inside super is much lower than what is outside super. So in Anna's situation, if you could wave a wand and magically have all those properties inside super, firstly, it's going to be negative cash flow. How are you going to get that negative cash flow into super to sort of soak it up to pay for it? And secondly, because of gearing rates and borrowing capacity, it's not even going to be possible anyway. Now, just as a reminder, back in February, I recorded episode 342, where I looked at the benefits of investing in property inside your super. One of the big attractions is no capital gains tax when you convert into pension phase, as long as you're below the transfer balance cap. There's always, it's funny, I say that sentence like it means something to everybody. Unfortunately, that it's so complex, there's always caps and things to think about, but just generally, no capital gains tax inside super. That's the main attraction. But the big downside is lower rates of gearing, higher interest rates, and much, much lower negative gearing benefits, because remember, the flat income tax rate for a super fund is only 15%, whereas outside it's up to 47%, so 3 times higher, which means you get 3 times more negative gearing benefits. So I did the analysis and worked out that that sort of all nets off. So actually, the benefit of no capital gains tax is offset by, higher interest rates, lower negative gearing, and lower gearing overall. because you can only borrow up to 70 or 80% of a property's value inside super. So you've got to put in some of your own capital. So it's neutral in terms of whether you invest in personal name or inside super. So that's sort of important to take into account when, answering Anna's question. Now, here's the problem with Anna getting advice from a financial planner and then another bit of advice from a property plan. Here's the problem is that the guys that prepared the property plan were probably able to look at the property. I said probably. Maybe they were able to look at the property and decide, look, is this good property? Is it going to work? What's the historic growth rate? Should we be selling any of these assets and either replacing them or doing something else with them? They could probably, maybe let's be generous with our assessment. Okay, they can answer those questions. But even if they decided, let's sell some property, they don't have the skill set and experience then decide what are we going to do with that money. Like they can't come back and say, sell these assets and make a non-concessional contribution into super because they're not licensed. It's a property plan, it's property advice. All they could really do is say, sell these assets and let's go buy some other assets and replace them, which isn't really the answer necessarily you're looking for. The flip side is the advice from the financial planner. When they look at the property, they might go, well, I don't know enough about it, and the problem with a lot of planners is they tend to be, quite focused on shares and super, and they talk a little bit around property, but they won't necessarily have the skill and understanding and talk about all the things that I talk about in this podcast. So that's kind of the challenge for someone in Anna's situation. So I'm kind of not surprised that they said do nothing. In fact, it's kind of a good outcome because they didn't really have the skill set, either of them, to tell Anna what she should do. So it's good that they didn't try and just create a transaction out of it, because I've seen some advice where a property investor goes to a financial planner and they say, sell all the property and put it into the share market. Well, clearly we understand where that advice has come from. And the property plan people, they could have said, look, sell a couple of these properties and replace them just to generate a transaction. So in a way, it's kind of good that that's the advice that Anna got. Okay, so let me go back to answering Anna's question, and really all the Annas out there. So that's, people that have relative, in terms of their overall investment asset value, relatively low amount inside super and are heavily invested into property. This is really a question for people like in that scenario. And so I go back to episode 358, how much wealth is enough? And that's what I really sort of talk about in there. So there's two things that Anna probably should want to do. Firstly, again, just on rough pre-tax, pre-CGT numbers, I've concluded that Anna's got about $4 million in equity in property. Now, just having a closer look at that, and it's not clear, but I think I would deduce that maybe 1.9 is their home, around about, I think. Look, it's hard because I don't have all the details. But let's be conservative, right? And let's say there's $2 million of net investment equity in the property portfolio. If we assume around about $2 million is their family home and about 420 inside super. So we've got $2.4 million of investment assets. Now, there might be a bit of capital, well, there will be a bit of capital gains tax in there. So let's maybe call it, let's say roughly $2 million. $2 million, and she's 43 and he's 47. Let's say they both work for another sort of 5-ish years. They actually they just need that $2 million to perform in terms of investment returns. Doesn't really need a lot of capital contribution from them. So in 10 years' time, let's say even if they work for another 10 years, for instance, I know they're not going to, but let's just say they do, that $2 million should hopefully double in value over that period of time. So that gives them $4 million. So that, they're kind of on the right trajectory in terms of having enough money, and their contribution from themselves isn't critical. Now, that's not to say that they shouldn't make contributions, like in terms of maximizing super and so forth. Of course they should. But from a do you have enough wealth? Are you on track perspective? I think the answer is yes. So we don't need to necessarily give rise to, any sort of additional gearing strategies or anything like that. It's really just about making sure, firstly, one, that the assets they have are going to perform, and then two, that those assets are in the right environment. Okay, so as I said, one of their problems is that they would like to improve their cash flow position a little bit more. So that's one thing. And then the second thing is we've got too much outside super and not enough inside super. So I think what I would do is I would have a look and ask myself, which one or two properties would I sell before I retire to make non-concessional contributions? The problem with waiting until after retirement, it looks like they've got 5 properties that earn an income, and then there's another property, which I'm not really sure whether it's a investment property or whatever, but let's say they've got 5. The problem with waiting and saying, oh, look, I'm not going to sell these properties now because I may as well wait until retirement and then I'll sell the properties because then I'll pay less capital gains tax. The problem with doing that is you've got to deal with the non-concessional caps. It'll take you too long to get that money into super. So you really have to start a little bit earlier. And so there's 2 reasons why I would sell a property now before retirement. Well, let's say there's actually 3 reasons. Firstly, to try and benefit and use from those carry forward non-concessional contribution caps. So that was the straddling each year and getting up to $1 million between 2 spouses into super. So they're probably not going to contribute that much, but at least they can get some into super now before retirement. It'll provide some cash flow relief. So you need to start thinking about which assets will I sell. I'll get back to that question in a second. But help them reduce debt in personal names and then allow them, they can still make maximum non-concessional contributions into super, but give them a bit of balance in their life. And the third element is how much capital gains tax will they sell, right? That's the question mark. Firstly, they've got assets still in their personal name. So they're going to be paying some tax, because they've got rental income, those sorts of things. So it's not like for people that have all their money inside super, then they get into retirement, they're actually in a nil tax position because super pensions aren't taxed. In their situation, they're going to be paying some tax. But the most amount of money you can save by delaying selling a property in retirement is about $35,000. Now, that's a lot of money, of course. But if you're going to pay $500,000 in capital gains tax, you're not really moving the dial that much. And the reason I say the amount of money you can save is $35,000 because that's the difference between how much tax you will pay between 0 and 190 at marginal. That's where the first 18,000 is tax-free and then the 18 to 45 is taxed at 18% and so on and so forth. And so at 190,000, because that's when the top marginal tax rate kicks in. So between 0 and 190, so on 190,000, you'll pay $55,500. Whereas if that whole $190,000 of income was taxed at 47%, you'd pay $89,000. So the difference is about $34,000, rounded off $35,000. That's how much per person you could save by delaying selling an investment property into retirement. So it's not a small amount of money, but by the same token, you don't want to forego a lot of other benefits just because you think you're going to make a massive saving on capital gains tax in retirement. Now, if the property's held across 2 people and you can spread that gain evenly, well, then maybe the saving could be up to $70,000. That's more considerable. So it depends on how you own the property, but we can't get, I think, overawed by, the potential capital gains tax savings by waiting into retirement. A lot can change between now and then. There's more holding costs, tax rates could change, the market could change, and the ability to make contributions into super could change. So there's so many factors other than tax to weigh up, or in addition to tax, I should say, to weigh up. So in their situation, in Anna's situation, okay, yeah, sure, she might end up paying a little bit more capital gains tax by selling a property now, but for all those other reasons, I think it makes sense. And so when I would come to work out which property to sell, if that's in fact what I wanted to do, the things that I'd be thinking about first and foremost is future expected returns. So I want to form a view on what these properties will do over the next 10 years and find the one that's going to perform or has the highest probability of underperforming relative to the remaining properties. The other things then I want to think about is how much capital gains tax am I going to pay? And typically the poorer performing asset tends to not have a lot of capital gains tax, so it's kind of convenient. And then lastly, I want to think about the cash flow impact. So if I do sell that property, I do get rid of that debt and make the super contributions, how much does it improve my personal cash flow position? So I think that's the answer is gradually move those assets inside super. I would probably start that process over the next couple of years. So that is before retirement. But I think the longer term goal for Anna is that she doesn't really need to acquire much more wealth. She just needs to make sure the current wealth that she has continues to appreciate. And so she can take her foot off the pedal a little bit from a cash flow perspective. She doesn't really need to be, aggressively repaying debt or anything like that. So she can find a little bit more balance, I think. Maybe one or two assets over the next 5-ish years to divest of and make non-concessional contributions into super to boost her super. And then I'd sell, maybe another one or two assets post-retirement as well, again, to boost that super. Now, I wouldn't necessarily sell them the day after you retire, maybe in the first 10 years. I don't know. I haven't looked at it right, but that's what I'd be sort of thinking about. But I think what it does, I think it's a great case study. I know I'm been banging on for a bit of time, but it's a great case study because a lot of people are in this situation. And I have in the past been in the situation as well. And it's a bit of a cautionary tale in terms of, sometimes I've looked back. I remember in my 30s, I was just thinking, oh my God, I'm working really hard. And all I'm doing is paying the bank. Like all I'm doing is making these loan repayments. And so you feel like, you're working really hard, but not really seeing many benefits. I mean, many lifestyle benefits. Now, that's fine in your 30s. Suck it up, Stuart. That's what's supposed to happen. But you just want to be cautious. And that's why I'm always really cautious, is to try and find that balance between, making sure you're really going to knock out your financial and lifestyle goals, and particularly making sure you're going to comfortable retirement, but also once you've done that, make sure you get some better balance and just enjoy life, particularly as your kids get older and they become a little bit more independent, you get a bit more of your life back. You may as well take the opportunity to enjoy it. So, Anna, I know that's not your real name, but Anna, thanks you so much for writing in. It's a really great case study. And hopefully that sort of commentary or analysis has helped. But now I just realize I haven't actually answered your question. Do you need a self-managed super fund? No, you don't, because I wouldn't be buying property inside super. You can't sell any of your residential properties into your super fund or move them or contribute them in. That's not permitted by law. You can only do that with what's called business real property, so commercial property. You can't do it with residential property. So because we can't move any of that existing property inside super, I wouldn't do it. You could say, okay, well, once if we sell and rebuy properties inside super, I wouldn't do that either. Because ultimately, I think you've got too much in property and you need to start transitioning to having more probably in shares and equities and more liquid assets that allow you to build an asset allocation that's going to be more in line with your risk appetite, albeit it's going to have more volatility than property, but that's an education piece a little bit. So, no, I don't think you need a self-managed super fund, but you do need a strategy on how to reallocate that wealth. Okay, next question is from George. A bit of a scenario again, a little bit simpler. So George is 37, his wife is 34. They've got two kids, a 4-year-old and just a newborn. George earns 210 plus super, wife 32 plus super on a part-time basis. Live in WA. Their home is worth about $1 million with a mortgage of 265, but it's fully offset. So essentially no home loan debt. Investment grade property in Queensland, 7 kilometres from the CBD. It's worth just over $1 million and the mortgage is 760. Purchased in 2022, so that's doing really well. Super balance for George, 290 and 60 grand for his wife. And they've got about 20 or nearly about 40 odd $1,000 in shares and ETFs. And here's the challenge. They would like to upgrade the home within the next 4 years, and they'll expect to have to spend about 1.6 on that. They would also like to buy another investment property, this time in Melbourne, for obvious reasons, as I've spoken about in the podcast, but their borrowing capacity is a little tight. I think they've got a borrowing capacity saying about 300,000, and he could draw another 200 from the offset account, but he doubts that's going to get him an investment grade property. He doesn't expect his income to change, but his wife will probably go back to full-time work in about 6 years' time. And so his question to me is, should we wait till our borrowing capacity is improved to purchase another investment property, or should we go for a better home in a better suburb? Okay, so the first thing that jumps out at me is that George is saying he could draw 200,000 from the offset. You've got to be really, really careful about contributing cash towards an investment property. So when you first buy a property, how you fund that acquisition, you have to live with for the rest of the time you own that property. So that is, if I go and buy a property for $1 million and put 200,000 of my own money in there and only borrow 800,000, I can't go back and change my mind 2 years later and go, oh, whoops, I shouldn't have put that money in there. I actually want to increase the loan back to $1 million, which is the purchase price, and withdraw my $200,000. I can't do that from a taxation perspective because it comes back to the purpose of which that increased loan monies have used for, and if it's just to repay me, it's not going to work. So you just got to be really careful about that. Some options for George: he could repay his home loan. So that is, take the 260,000 in the offset account and repay the $265,000 mortgage. So pay it down to $5,000. In that situation, you might be more comfortable actually doing that, but refinancing the loan to say $50,000 or $60,000 on the interest only perspective, so that you've still got sort of a bit of a buffer. You can redraw if you like, and put it on interest only. So the actual balance is $5,000. Big deal. It's not going to cost you a lot of money. You can repay it, but you've always got that redraw there. If George does that, that frees up a little bit more borrowing capacity for him to be able to borrow for an investment purpose or otherwise. But I think because George is 37, wife 34, their super's not too bad for their ages. What have they got combined? About $350,000. That's pretty good. I'm not concerned there. They've got a good asset in Brisbane, so that's really good too. The problem is if they don't do the upgrade to the home as soon as possible, it's just going to cost them more and more from after-tax dollars. So I reckon that's the next step. I think George has prioritised the hard work in terms of repaying his home loan, getting his debt down, and buying an investment grade asset. So they're the key things that George has done and should have done as a priority. And so now I think he can prioritize or balance out both lifestyle and financial goals. And also, I talk a lot about taking investment lens to a home purchase and the benefits, the long-term benefits, both from a lifestyle and a financial perspective of doing that. So, George, if I was in your shoes, I would be thinking about how I could do that upgrade as soon as possible. So move from your place to the $1.6 million place. Obviously, you've got to bridge about $600,000 of that gap. That's the gap in terms of the value. And so, you've got 260,000 of that already in offset account monies. So really it's about sort of 350 grand. Well, interest rates coming down, you don't need a lot to sort of change for you to be able to get an extra $360,000. You said your borrowing capacity is about 360, so it's very close. It's very close, it seems to me, for you being able to do that. And I think that should be your priority. Then once you've done that, and then you've got sort of on top of that debt, I'm not saying brought it down to zero, then I'd think about potentially another investment property. But for your income and position, unless your family income might change in 6 years' time when you go back to work. But for your income, I think that's enough gearing, really. If your income wasn't going to change, I'd probably stay for one investment property and maybe something down the track. But as I said, that investment property in Brisbane, the value's $1 million and the debt's 760. Well, in 20 years' time, when you'll be sort of approaching 60 yourself, that property should hopefully be worth $4 million and you've got 760 of debt against it. That's north of $3 million of equity now. $3 million of equity in 20 years' time is equivalent to about $1.8 million today. But if I put another $1.8 million in your pocket, of course, you've got to pay some capital gains tax. So let's call it 1.3 or 1.4. It's still a pretty significant boost to your retirement savings. So you don't really need a lot to go on here, a lot to do right. I think that one investment property, do the upgrade, repay debt, maximize super contributions. I think if you do all those things well and your super is well invested, that alone probably should be enough. But otherwise, you don't need to do a lot more right other than that. Okay, only 2 questions answered today. So unfortunately, I prattled on about the first question for Anna, but hopefully it's useful to everyone, particularly given a lot of people like to think about investing in property and sort of how that transitions into retirement. Okay, I've got I'm excited to share the episode that I've got lined up for tomorrow. 4 golden rules, property investment golden rules, that sort of bringing all the sort of evidence-based research together to try and give it to you in one coherent episode. Well, that's the goal anyway. Let's see how I go. Until then, bye for now. Just a few things before we wrap up, if I may. Of course, you can send me questions at questions@investopoly.com.au. But for a quicker response, feel free to add a comment on the episode's video over on YouTube. We have an Investopoly YouTube channel, and the link is in the show notes. I'm incredibly grateful for the 4.9 star rating on Apple with over 400 reviews. Thank you so much. If you can leave a review or rating, I'd love it, because I'd love to get over 1,000 reviews. That's kind of my target. Keep checking the show notes for free downloads, and I include book discounts there as well. And of course, if you're interested in working with my team and I've included a web link where you can find out a little bit more about what we do and get in touch with us. And of course, until next time, bye for now.